Welcome to the deep dive. We're here to really unpack the complexities of your financial world, turning them into, well, actionable insights. So you've put in the legwork, right?
Well,
Found the property, navigated the market, got that offer accepted. Feels like the end.
it really does feel like the finish line, but honestly, that accepted contract is more like the starting gun. It kicks off this final, super critical financial phase.
Hmm.
A lot of investors, especially newer ones, they get laser focused on that purchase price.
Right, the big number.
Exactly. And they kind of miss the forest for the trees. They overlook all these other accumulated costs, the
Wow.
legal hoops you have to jump through, those sometimes hidden fees that really make up the final investment. We need to get past the aha moment of the contract.
Okay. So our mission today is to push past that initial excitement, that euphoria, and really drill down into the nitty-gritty, the contractual points, the financial details, everything that determines your actual total investment basis.
Every single dollar, every deduction, every credit, every piece of paper that locks in whether this deal is truly profitable or not. And central to making this shift from just wanting the property to actually calculating its true cost is this core idea, due diligence.
Due diligence. Okay, everyone throws that term around. Let's define it. But specifically for an investor who's really focused on this final financial stage, what does real due diligence look like here?
Yeah, good question. It's more than just ticking a box. In this context, due diligence is that systematic, really thorough investigation of the property, yes, but also the transaction itself. And crucially, you do this before you let the deal close. The sources define it as gathering all relevant info to make sure the investment holds water.
So not just the standard home inspection then.
Oh, definitely not. That's
Right.
part of it, sure.
Right.
But professional due diligence goes way beyond. You're confirming structural stuff, obviously, but also things like zoning. Did you actually use this property the way you intend? You might need environmental reports, especially for older buildings or commercial sites.
Right, things that could come back to bite you later.
Exactly. Is the current use even legal? Are there hidden costs down the road, like mandatory city upgrades or special assessments nobody mentioned? This kind of deep dive, this investigation, it shifts the whole thing from an emotional, I want this house, to a calculated, disciplined business decision. It helps you anticipate some of those final closing costs, too.
Okay, that makes sense. Discipline is the key word. Which brings us neatly into establishing that total investment basis, moving beyond just the sticker price. We need to talk about the mindset first, right? Before we even get to the numbers.
Absolutely. This is foundational. It's about building and protecting that asset column. The materials we looked at really emphasize that successful investment thinking, it follows a process designed to save time, cut down risk, and keep you squarely focused on generating long-term wealth.
And a big part of that philosophy is how you view money itself. There's that powerful idea of money as an employee, isn't there?
It's a game changer, honestly. Once a dollar goes into your asset column, meaning it's working for you, generating income or appreciation,
Mm-hmm.
you treat it like an employee.
Mm.
Employee that works 20/47, holidays, weekends, potentially for generations. And the rule is, you don't fire that employee. You don't take it out of the asset column for, say, a fancy car.
Yeah, that really highlights the opportunity cost. If I pull, I don't know, 50 grand out of my investment portfolio for a luxury vehicle, I'm not just down 50 grand.
Not even close. You've lost the compounding power of that $50,000 over maybe 30, 40 years. You didn't just spend the principal. You basically fired your best worker, someone who could have made you hundreds of thousands more down the line.
Mm.
It's a fundamentally different way of thinking.
And the sources really draw a sharp contrast there between those who build actual wealth and those who maybe just look wealthy.
Oh, absolutely. The poor and middle class often get caught in this cycle, right?
Mm.
They buy the luxuries first, the nice car, the big TV, often financing it with future earnings, with their own sweat and time. They're leveraging their labor,
So they look good, but the debt's eating them alive.
pretty much. Whereas the long-term wealthy, they flip the script entirely. They focus relentlessly on building that asset column first, real estate, businesses, stocks, whatever it is. Only when the income from those assets is enough, then they buy the luxuries.
Delayed gratification, powered by compounding.
Exactly. And to make that work, you need discipline with spending. That old saying holds true. The first cure for a lean purse is to spend only 9 coins for every 10 you earn. That 10th coin, that's your seed capital. Controlling your spending is how you plant it.
Okay, so that discipline is crucial. Now let's apply it directly to the deal mechanics, calculating the actual net cost of the property. Because, like you said, it's almost never just the price on the contract.
This is where a lot of people stumble. They budget for the purchase price, maybe closing costs, but they miss chances to adjust their basis down based on what happens during the transaction. There's a great example in the source is a renovation project. Initial purchase price, $10,000.
Okay, sounds simple enough. So how does a disciplined investor chip away at that number before closing?
They use their due diligence findings. Let's say the inspection found a problem, a dodgy porch maybe. Instead of making the seller fix it, which can cause delays, they negotiated an escrow credit, say $380 specifically for the porch repair. That amount is subtracted from what they owe at closing.
Ah, okay, so it reduces their immediate cash outlay.
Precisely. Then maybe there were prorations, things like property taxes the seller had prepaid, or maybe utilities. Let's say the buyer got another $70.22 credit in escrow for those adjustments.
So just by negotiating repairs and handling the prorations smartly, that $10,000 gross price instantly becomes, what, $9,549.78.
Exactly. That's your net purchase price.
Yeah.
Huge difference already. But for an investor, it doesn't stop there. You have to track every single dollar you put in after that to improve the property capital expenditures. Let's say they spent $2,500 on essential improvements, maybe a new water heater, some electrical work, things needed to rent it out or sell it.
Got it. So that $2,500 gets added back to the net purchase price.
Right. Which brings the final true cost of that investment, the total investment basis, to $12,049.78. That's the number you need for calculating your real profit later, your tax basis, your ROI.
So if you don't meticulously track those credits you received at closing, the specific fees you paid as part of closing costs and all those later improvements, you're flying blind when it comes time to figure out your actual return.
You're absolutely flying blind. Your numbers are wrong. Your potential profit calculation is wrong. That total investment basis is everything.
Okay. Now, most people don't buy property with cash, so let's talk financing. Often called the eighth wonder of the world, leverage.
Leverage is powerful stuff. It's the ability to control a big, expensive asset with relatively little cash down. That's why real estate can be so explosive for wealth building, right? If the property value goes up, your returns on your actual cash invested are magnified hugely.
But there's always a but, isn't there? The sources give a pretty stark warning, too.
They absolutely do. Leverage is that classic double-edged sword. If you use it unwisely, if the market dips, if you take on too much debt, it magnifies your losses just as dramatically. Understanding your loan terms, the risks involved, it's critical.
Let's touch on a couple of common financing routes. For many home buyers, especially first-timers or those with maybe lower incomes, FHA loans are pretty standard. What's the strategic angle there?
So the FHA, Federal Housing Authority, they don't actually lend the money. They insure the loan for the bank or lender. That insurance makes the lender feel much safer, so they're willing to offer better terms to borrowers who might not tick all the boxes for a conventional loan. Meaning lower down payments, often just 3.5% down, and usually more flexible credit score requirements. It's designed to boost homeownership by lowering that initial barrier to entry. It makes buying more accessible.
Okay, that makes sense for buying your own home. But what about our investor, the one eyeing that distressed property, the one needing 50 grand in repairs right off the bat? Traditional banks hate lending on those, right?
Oh yeah, banks generally want move-in ready collateral. That's where private lenders often come into the picture for investors. We're talking about borrowing from individuals, maybe small investment groups, specialized funds, basically, not your big institutional bank.
Sounds less regulated, maybe riskier. Why go that route? What are the trade-offs?
The big advantages are speed and flexibility. If you're flipping a house, you need money fast. A bank might take 60 days. A private lender could potentially close in a week or two. Plus, they're often willing to lend based on the property's future value, the after-repair value, or ARV, which banks rarely do.
Okay, speed and ARV lending, but what's the catch? The risk has to be higher, so the cost must be too.
Definitely. Interest rates are typically much higher with private money, think 10%, 15%, maybe even more. And the loan terms are usually very short, 6 months, a year, maybe 2. It's not long-term financing.
So how do you manage that risk?
You need a rock-solid plan. A strong relationship with the lender helps. You absolutely must have a clear exit strategy. Either sell it quick or refinance into a conventional loan once the repairs are done. And you have to factor that high cost of capital right into your initial total investment basis calculation. It's a great tool for short-term projects, but if your timeline slips, it can get very expensive very fast.
Right, that higher interest becomes a significant closing cost in itself, or at least a carrying cost you have to factor in. Okay, so we've got the mindset, the cost tracking, the financing tools. Now let's walk through the actual transaction life cycle, the legal and contractual steps after the offer is accepted.
First thing, and you need to do this basically immediately, make your earnest money deposit. This shows you're serious, acting in good faith. That money goes straight to the closing agent, could be a title company, an escrow officer, an attorney, right after everyone signs the contract.
Uh-huh.
It's security for the seller.
And let's talk about the contract itself. If I'm a buyer and the seller's agent hands me their standard contract, the sources suggest I should be a bit wary.
You absolutely should. It's a key point. Those standard agent contracts, they're often written, subtly or not so subtly, to protect the seller because traditionally the agent represents the seller. They might have clauses that limit your options if the seller backs out, or really tight deadlines for inspections that put you under pressure.
So I'm not just stuck with it. How does a smart buyer push back and protect their own interests, especially regarding potential costs or repair issues?
You modify it. You absolutely can and often should. The best way is usually with a separate addendum. This is a document you attach to the main contract. It lets you add your own specific terms. Maybe you want longer for due diligence, or you want to cap how much you'll pay for potential repairs found during inspection, or you want the seller to cover certain closing costs. The addendum overrides the original contract language.
And how do you make sure that's clear legally?
Clarity is everything. If your addendum changes something in the main contract, you need to physically or digitally strike through the words or sentences in the original document that the addendum replaces. No ambiguity. This ensures your terms are the ones that stick, protecting your bottom line.
Okay, contract signed, addenda attached, earnest money delivered. What's the very next critical step, legally speaking?
You immediately send a copy of that fully signed contract to whoever is handling closing your title company, closing attorney, or escrow company, and you tell them to order the title search.
Let's break that down. For listeners who might not be familiar, what is a title search actually looking for, and why is it so vital for your final financial picture?
The title search is basically a historical background check on the property's ownership. They're digging through public records to make sure the seller actually has the clear right to sell it to you. They're looking for any clouds on the title, things like old mortgages that were never paid off, unpaid property tax liens, judgments against previous owners.
Or easements, right. Those can be nasty surprises.
Oh, easements are huge. An easement is a legal right for someone else to use a part of your property for a specific purpose, like the utility company might have an easement to run lines, or a neighbor might have one to cross your land to get to theirs. If you don't know about these, they could seriously limit what you can do with the property later, affecting its value. Any of these issues found in the search need to be cleared up by the seller before closing.
And this is where title insurance comes in, right? As a protection against things the search might have missed.
Exactly. Title insurance is non-negotiable, really. Often the seller pays for the owner's title policy for the buyer, but you need to make sure you get it. It's a one-time fee paid at closing, part of your closing costs, and it protects you. If years down the road some previously unknown error pops up or an old lien surfaces that the search missed, the title insurance company has to defend your ownership in court or pay you for the loss. It prevents a potential financial nightmare.
Oh, okay. And one last point on the legal side. What if the buyer isn't an individual, but an entity like an LLC? Does that complicate the due diligence?
Oh, significantly. If you're buying through an LLC, your legal due diligence has to be spot on. You need to make absolutely sure the LLC is properly set up, it's in good standing with the state, and importantly, that the person signing the contract actually has the legal authority to bind the LLC, according to its operating agreement.
And if you mess that up?
Big problems. The contract might be invalid. Or worse, you could pierce the corporate veil, meaning the owners could become personally liable if something goes wrong. That defeats the whole purpose of using an LLC for protection in the first place.
Right. Okay, so we're now in the escrow period. That time between contract acceptance and the actual closing day can feel like limbo, and things can get tense. Why is constant communication from the agent or whoever is managing the deal so crucial here?
Because escrow is where the financial rubber meets the road.
Mm.
This is when inspections happen, appraisals come in, repair negotiations get serious, the loan gets finally approved, title issues get resolved. Any one of those steps can throw up a roadblock or an unexpected cost.
So the agent needs to be updating the client constantly.
At least weekly, maybe more. Because things change fast. An inspection reveals a problem, now you have to negotiate repairs or credits. The appraisal comes in low. Now you might have to renegotiate the price or come up with more cash. Loan underwriting hits a snag. Title finds an issue. It's often like juggling flaming torches.
And the agent isn't just talking to their client, right? They're coordinating a whole bunch of people.
Exactly. They're the hub. They need to be in constant touch with the other agent, the title escrow officer, the lender's loan officer, maybe attorneys on both sides, the appraiser, the home inspector, termite inspector, repair contractors getting bids.
Yeah.
It's a complex communication web.
And if that communication breaks down, what's the typical financial hit for the buyer?
Delays are the most common killer. A delay can cost you real money. Maybe your rate lock expires and rates have gone up. Maybe there are per diem charges from the lender, but often it's about negotiation leverage. A small repair issue that could have been solved easily can blow up into a major fight if communication is poor, maybe even killing the deal and costing you your earnest money, not to mention inspection and appraisal fees already spent. Good communication is basically free risk management.
Makes sense. Okay, let's shift gears slightly and look at the longer-term picture. Beyond the closing itself, how does this transaction impact your finances, especially taxes? The first big concept here is depreciation.
Depreciation. For rental property owners, it's arguably the biggest tax advantage. It's a non-cash deduction. Basically, the IRS lets you deduct a portion of the property's value, the building part, not the land, each year, theoretically because the building is wearing out over time.
Even if the property is actually going up in value? Seems a bit counterintuitive. How does that actually save you money on taxes?
It works by creating a paper loss that offsets your actual cash income from the property. Let's use that example from the source material. Say your rental property brings in $20,000 in positive cash flow before taxes for the year. But based on IRS rules, you might get an $18,150 depreciation deduction. Now, you didn't actually spend that $18,150.
It's just a deduction on paper.
Exactly.
Yeah.
So even though you pocketed $20,000 in cash, you only pay income tax on the difference. What's $20,000 minus $18,150?
Right. Your taxable income from that property is just $8,850. The rest of that cash flow, that $18,150, comes to you effectively tax-free for that year. It's a huge benefit for sheltering rental income.
And sophisticated investors can even accelerate that.
Yes, through something called cost segregation studies. They break down the components of the building and depreciate some parts faster. It pushes more deductions into the early years, maximizing that tax shelter effect up front. You have to think of investment property not just as income, but as a tax management tool. Okay, depreciation shelters income along the way. But what about when you sell and realize big profit? Capital gains taxes can be brutal. There are tools for that too, right? Let's start with the one for homeowners, IRC Section 121.
Right, the home sale gain exclusion. This is a fantastic benefit if you're selling your primary residence. For married couples filing jointly, you can exclude, not defer, exclude up to $500,000 of profit from capital gains tax. It's just gone, tax-free.
Wow, $500,000 tax-free. What's the catch? The residency rule.
Yeah, you have to meet the ownership and use tests.
Yeah.
You must own the home and lived in it as your primary residence for at least 2 out of the 5 years leading up to the sale date. Doesn't have to be continuous, just 2 years total within that 5-year window. For single filers, the exclusion is $250,000. It covers most people's gains on their home.
Okay, great for homeowners. But for serious investors, especially with properties held long-term or commercial assets, the gains can easily blow past $500. That's where the 1031 exchange comes in, right?
That's the big one for investors. Section 131 of the tax code allows you to defer paying capital gains taxes and depreciation recapture taxes, which is important when you sell an investment property, if you reinvest the proceeds into another like-kind investment property.
Like-kind is pretty broad for real estate, isn't it?
Very broad. You can exchange raw land for an apartment building, an office building for a rental house, as long as it's real property held for investment or business use. The key is you're deferring the tax, not eliminating it. It lets your capital keep working and compounding without taking that tax hit immediately.
Sounds amazing, like kicking the tax can down the road indefinitely. But I hear it's incredibly strict. What are the absolute must-follow rules? The ones that can instantly kill the deal if you mess up?
Oh, they are unforgiving. Rule number 1, you absolutely must use a qualified intermediary, QI. This is a third party who holds the money from the sale of your old property. the relinquished property. You, the seller, cannot touch those funds, not even for a second. If the proceeds hit your bank account, it's called constructive receipt, and boom, the exchange is dead, taxes due.
Okay, QI is essential. Then there are the timelines, right? The infamous 45 and 180 days.
Yep, the clock starts ticking the moment you close the sale on your original property.
Oh.
From that day, you have exactly 45 days to formally identify, in writing to your QI, the potential replacement property or properties you intend to buy.
Only 45 days. That sounds incredibly tight, especially in a hot market.
It is intense pressure. And then you have a total of 180 days for the date you sold the original property to actually close on the purchase of one or more of those identified replacement properties.
And these deadlines are strict. No wiggle room.
Zero wiggle room. Weekends, holidays, doesn't matter. Miss the 35-day identification deadline or fail to close within 180 days. The entire gain from your original sale becomes taxable in that year. Ouch.
Wow. Okay, what about identification? Can I just identify one property? What if it falls through?
There are rules for that, too. The most common is the three-property rule.
Mm-hmm.
You can identify up to 3 potential replacement properties, regardless of their value. Or there's the 200% rule. You can identify more than 3 properties, but their total fair market value can't exceed 200% of the value of the property you sold. You have to actually acquire one or more of the properties you properly identified.
Okay, QI, 45 days, 180 days. Anything else critical?
Yes, one more big one related to what we discussed earlier about LLCs. The taxpayer who sells the relinquished property must be the exact same taxpayer who acquires the replacement property. So if my investment LLC sells property A, then my investment LLC must buy property B. You can't sell through your LLC and then buy the new property in your personal name, or vice versa. That also blows up the exchange.
So meticulous planning with your QI, your attorney, your tax advisor before you even list the first property is absolutely key.
Non-negotiable. You have to structure it correctly from the very beginning.
Okay. We've covered the structure, the taxes, the legal steps. Let's talk about the most dynamic way to impact your final costs: negotiation.
Ah, yes. This is where you can make serious money in a short amount of time. The sources point out, and it's true, negotiation often yields the highest effective hourly rate an investor will ever earn. Think about it. You spend maybe 15-20 minutes on a phone call, skillfully negotiate a $10,000 price reduction or seller credit.
You just made $30,000 or $40,000 an hour, effectively.
Exactly. It reframes negotiation from this awkward haggling thing into a critical financial tool. And a key insight from the sources is to focus not just on why they should make the deal, but on why they might not want to.
So understanding their potential objections or fears first.
Precisely. It's about clearing the barriers. People are often more motivated by avoiding pain or loss than by potential gain. Why might they not agree? Maybe they fear looking stupid to their spouse or agent. Maybe they're terrified of the deal falling through and having to start over. Maybe they're under a time crunch. If you can figure out their no, their underlying fear, and address that, you unlock the yes.
Okay, tactically then, how do we make concessions without giving away the farm? There's that tit-for-tat rule.
Foundational. Never ever give a concession without asking for something in return. Frame it conditionally. Okay, if I can agree to close a week earlier like you need, point X, would you then be willing to cover the cost of the home warranty, point Y?
Why is just giving in on a small point so bad? Seems easier sometimes.
It signals weakness. It invites nibbling. They think, oh, they gave on that. Maybe I can get this other little thing too. It just encourages them to keep asking. But more subtly, it can make the seller start second-guessing themselves. They agreed pretty quickly. Did I price it too low? It can actually destabilize the deal later. Tit for tat keeps things balanced and reinforces the perceived value.
Interesting. Okay, so this ties into psychology, doesn't it? Specifically loss aversion. The idea that losing $100 hurts more than gaining $100 feels good. How do we use that in negotiation?
Loss aversion is incredibly powerful. It means people will work harder to avoid a loss than to achieve an equivalent gain. So when you're negotiating, focus on what the other side stands to lose if the deal doesn't happen. This is negative leverage.
Give me an example. Instead of just offering more money.
You frame it around their potential losses. It sounds like if this doesn't close by the end of the month, you might lose the deposit on the new house you're buying. Or, I understand wanting top dollar, but it seems like having this sit on the market for another 2 months through winter could end up costing you more in carrying costs and potentially a lower offer later. You're highlighting the pain of not making a deal.
And you mentioned using labeling. How does that work?
You gently articulate the fear or problem you sense they have. It sounds like you're worried about the hassle of dealing with repairs, or seems like you're under pressure to get this closed quickly. By naming it calmly, without accusation, you bring the underlying issue into the open, making it easier to address and showing empathy, which builds rapport. It's much more effective than just hammering on price.
Powerful stuff. And finally, on concessions like asking the seller to contribute to closing costs, when's the best time to bring that up?
Get in there early. Test the waters during those initial, more casual conversations, even before you make a formal offer. When they're eager to attract interest, sellers or their agents might be more open to smaller concessions just to get things rolling.
So casually ask something
Like, just curious, have you folks thought about offering any help with closing costs? Or is seller financing something you might consider? Getting even a small concession agreed upon upfront can psychologically anchor the negotiation and reduce those potential financial surprises during escrow.
excellent. Okay, let's try to wrap this all together.
So to really nail the final financial aspects of a real estate deal, it's clear you need this comprehensive, really disciplined approach. It goes way beyond just that initial handshake on the price.
Right. We started with the investor mindset, solid due diligence to sniff out hidden costs, treating capital like a tireless employee, and crucially, tracking every credit, every fee, every improvement to calculate that true total investment basis.
Yeah, and we walk through the legal steps, getting that earnest money in fast, using addendums to customize contracts and protect yourself from unfavorable clauses. Plus, the absolute necessity of a title search and title insurance to avoid nasty surprises down the road, all contributing to that final cost.
Then we hit the long game, taxes. Understanding how depreciation shelters cash flow, making it effectively tax-free, and mastering the complex, high-stakes rules of the 1031 exchange, the QI, the 45-day clock, the 180-day deadline, the same taxpayer rule to keep your capital growing tax-deferred.
And wrapping it up with negotiation, seeing it not as a hassle, but as your highest paying work. Using tit for tat, leveraging loss aversion, getting concessions early. The sources really nail it. Successful pros are disciplined, they're consistent, they think deeply about what they're doing and how they're doing it.
Which leads perfectly into our final thought for you, the listener. We know that the total return on investment, your ROI, it's a function of a few key things. Appreciation over time, the principal you pay down on your loan each year, plus your annual net cash flow, all divided by your initial cash investment, your down payment, plus those closing costs. Now, let's say you've absolutely mastered tracking every single component of your net cost, the credits, the fees, the financing nuances, the tax benefits, the negotiation wins. You've got all the financial and mechanical ducks in a row. What unforeseen factor, one that's not about dollars or documents, but purely about human behavior, still poses the biggest threat to maximizing that ROI you worked so hard to calculate?
Something to definitely chew on. It's that variable you just can't perfectly model in a spreadsheet. We'll leave you with that thought. Thanks for joining us on The Deep Dive.